Welcome to the FounderVideo podcast, an interview series bringing you the latest and greatest info on B2B marketing, revenue operations, and go-to-market strategy from respected experts. Here is your host, Will Martin.
All right, so we're here for the 17th episode of the FounderVideo podcast. Today, I'm really particularly excited about this episode because we have Guillaume Jacquet, the founder of Vasco, one of the up-and-coming platforms. Well, I don't think there's nothing quite similar to this. You guys will see, but it's a GTM platform. We'll dive deep into it. It's helping modern go-to-market teams properly execute, analyze, and plan for a better and more efficient strategy overall. Pleasure to have you. I don't know if that was a good intro, but yeah.
It was a great intro. Thank you so much for inviting me.
Sure thing. So first thing, because many people might not have heard about Vasco yet, even people in the GTM space. So why are we here? What is Vasco? How is it shaping the future of GTM?
Yeah, Vasco, the elevator pitch is we're an end-to-end revenue operation platform for ambitious SaaS businesses. So basically, you know, the framework of winning by design and revenue architecture, well, we take that framework and we empower revenue operations teams to be able to implement that framework within their SaaS company. And often it's very hard to do because you have to extract the data from many sources and you have to correct it, you have to adjust, and then you compile them together and you provide a static view of the business. Well, Vasco abstract entirely that complexity, empower you with the tools so that you can spend more time actually understanding what works and what doesn't within your go-to-market engine, rather than spending hours compiling broken spreadsheets together.
Love that. That's a really good elevator pitch.
Thank you.
How does this fit into the new era for efficient growth in SaaS? You know, we've seen, all of us have seen the debacle in 2020, 2021, and after how, money was pretty much free at that point, and that has hurt a lot of SaaS companies with a fake sense of product market fit, a fake sense of go-to-market fit, and most importantly, a really not efficient go-to-market strategy. How does Vasco help shape a different picture moving forward?
Now, of course, and we're living in a different era, and I think people are going to look back at the golden age of SaaS more like as a time where there was a bubble. I think something that people don't talk that much about is because tech was growing so much and tech consumes a lot of tech product. Then tech companies were buying product from one another. And the only module at the time was you need to grow. Top line growth is the only thing that matters. Efficiency, you'll see later once you have a positioning in a market that is going to be dominant enough. And people were just throwing money at growth. And the reason is the cost of capital was very low. VC were willing to invest in companies. And founders were encouraged to go through that route. The problem is that this is not sustainable in the long term, right? You have always a time where the cost of capital starts to become a bit more tougher when market conditions start to stabilize. And now, a lot of those companies, they're having their board open up the kimono and asking them, okay, so let's dive in. Tell me, what is your win rate? What is your win rate by channel? Where do you win? What's your conversion rates and pipeline generation rates? What's your LTV over CAC by channel, by go-to-market motion? And none of these answers come easily. Why? Because people have been spending on channels, and as long as it was converting into some kind of pipeline that was converting into closed one, we were happy. I've been, in boards of companies or advisors of startups and had different experience. And sometimes I have from my network people who tell me, well, we've opened up a few elements and we've seen 5 million poured in paid social in the last 6 months, and the LTV over CAC was 0.5x. And you're wondering, oh my God, how is this possible? And the problem when you do that is that actually you think it's okay, you just revert back. Well, first of all, growing more efficiently is very hurtful within a company. Everybody who's gone through that know that it's a tough time and a big transformation and a culture shift as well. But you need the data so that you can actually continue to do what's working and divest into what's not. And Vasco, is kind of the map that will guide you to tell you actually where you have go-to-market fit and where you should either descale or refine the module.
Love that. You mentioned you're a member of many boards, and you've talked to investors before. You've seen the game. You've seen how it plays, right? Tell us a little bit more about your background. I know that you founded a company, you sold it, then joined the acquirer and took it public. Tell me about that experience. You also had previous experience in finance and M&A and whatnot and VC. So, what should people, I guess, to frame the question, right? What should people know about your past to understand why you're a good fit to be building this sort of product, and how is that ingrained in the vision of the product itself?
100%. So first of all, I have had different lives. Before I went into entrepreneurship, I started in finance, and I used to love finance theory, and so on. It's funny, like maybe a subject of conversation for another podcast, but a lot of the metrics that we study in finance have been adopted to SaaS. For instance, LTV is a variation of NPV, LTV over CAC is a variation of NPV, net present value. But I love numbers and understanding how a system works, and I think that's my finance education that got me there. And then I started a career in venture capital and got the entrepreneurial bug and decided, I want to walk the walk and talk the talk. So I started and built a first company. That company was in the golf industry named Chronogolf. Think about it as the open table, but for the golf industry. We started it with 3 other co-founders. One of them is actually my CTO and co-founder in Vasco as well, Sebastian. And we went through the route, of raising a first round of financing and building the product, and everything was well. We had a few beta users and so on, and we're like, okay, now it's time to scale. And as we scale, we did what every entrepreneur at the time thought was the right thing when they come from go-to-market. We said, well, let's hire salespeople. They're just going to sell, and then you make the math of just, okay, I need to do $1 million. I'm going to hire, 4 reps who do $250K each, and they will figure it out. None figure it out. And then we came back and said, okay, well, we're going to do inbound. And then we said, let's send a few emails and 3 social media posts, and it's going to come. And nothing came. And actually, this is where we started to go back, have that haha moment, and said, okay, this is like, we have to be more serious, and we need to get involved in this with the entire team. And we started deep into the rabbit hole of understanding how, to treat sales as a science. And at the time, you have to remember it was 2014, 2015. The cloud was growing, and you had a few pioneers that were starting to pave the way. I'm speaking about Aaron Ross, for instance, who's an advisor now to Vasco. So very excited about that. It's built Predictable Revenue, a little less known, but a beautiful book also, From Impossible to Inevitable. Predictable Revenue was about how to build predictable pipeline and starting to specialize pipeline generation versus pipeline closing. Because if you give sales rep, the goal to build a pipeline, close pipeline, and then onboard, retain, and expand, when they retain, they don't close. When they close, they don't build pipeline, and you never have the flow. And it takes them 18 months to ramp up. So in the end, you don't know why, but you don't feel that the next step is smaller than the previous one. You feel that each step is as hard, and you need to go against the current. So he advocated specialization around the customer journey. It was one of the first one. It was enabled by the fact that with cloud-based technology, you don't need field sales rep that just shake the hand of anyone, and you can start really gathering leads online and doing outbound and closing remotely. And you had sales acceleration from Marc Roberge, another big advocate of sales as a science. So I went deep in there, and we transformed completely Chronogolf and we first bought a decent CRM, HubSpot, And we started to really start there. And we said, well, if we want to lift the company, it's not about closing, we need to lift pipeline generation. And we started to be extremely methodical, posting online very regularly, doing things, measuring, doing sprints of 1 week and measuring the conversion rate from lead to MQL to SQL to pipeline to closed one. And I remember vividly as we started to see pipeline do this, but close rate were not following through. And at the time, everybody was saying, wow, we'll see. And they were all focused on closed one. But we knew 3 to 4 months before that it was coming. And then once you do that, then you open up new channels, and you go to market motions, and you continue. But then it became inevitable in some way. And Chronogolf, thanks to that model, we raised 2 subsequent round of financing. At one point, the size of the market didn't enable us to grow any further. We're basically speaking to every potential lead in the market. And we sold the company to a company called Lightspeed. Lightspeed is a payment and POS platform based out of Canada. Just to give you an idea, it's listed on the NYSE, around $3 billion valuation. It's an amazing company who had also implemented high velocity sales, but at scale and in a huge market. So the business got acquired. We got a nice return from our VCs, and I'm sure you speak about it with, maybe I can get your feedback as well, with a lot of entrepreneurs and people who start and so on. But then I started coaching through what my VC asked me, some of Series A entrepreneur or friends and things like that. How did you do it? They saw that we were successful in bringing that method. And I started talking with a few of them, and I realized I was spending the first 10 minutes were always the same. Did you sell product market fit and you don't have it to your VC? Because if you don't have product market fit, just go and build product market fit. But if you do really have product market fit, which I try to validate every first minute of call, then the 50 minutes following that call, I was saying exactly the same thing over and over and over and over again. And it felt to me that this could be somewhat productified, especially because most of those people, they understand it in principle, but actually putting it in place is super hard. And you need to build the right data model, adjust your CRM, measure, iterate, build initiative, get really, the different sub-elements within the BowTie that tells you, where you need to refine and work. And I got frustrated because out of the 15 sessions that I've done, there are just a couple of them that really lifted and go to Series B, Series D, and so on. And it's the one where I was coaching the founder every week. And I wished I had a product that I could use as a forcing function to actually help them see what I saw and see what I was seeing in Lightspeed, which had high velocity at super scale and had different issues, by the way, because when you scale high sales velocity, then you start to lose the view from lead to cash in region, geographies, segments, markets, blah, blah, blah. Like you start to have so much specialization that revenue factory is going in so many places and how to make sense of it. But the initial, what I wanted to do was to help those startup and scale up implement the best practices for revenue architecture so that they can find and scale go-to-market fit and increase their chance of success.
I don't want you to go through the 50 minutes that you repeated many, many, many times with those founders, but I mean, I would pay to see those 50 minutes, because even if it's hard to implement, I think a lot of founders would. Because you can study revenue architecture, but the way you could communicate it, I don't know how good your communication was on that end, but I mean, if and coaching is like that always, right? Like I assume that was part of what turned you off from coaching, right? Like I don't want to spend time with 50 people for only 2 to have success, right? I'd rather build something that it's useful for everyone who knows how to use it and detach a little bit from that high touch experience. Wow, I have so many questions from that story. Like, I don't know where to start. But I would say, tell us about that pipeline architecture that you envisioned and that you were able to see and that those founders were not able to see and that you implemented both at Chronogolf and that you saw at Lightspeed, that high sales velocity at super scale. Because you said you tried inbound, you tried outbound, you tried hiring reps. Nothing was working. I'm assuming it's not easy to compress in a podcast. Of course, I'm not asking for a comprehensive answer, but how did you figure that out, and how are you embedding that into Vasco right now?
100%. So I'm going to try to give you, it was a longer time ago, but I'm going to try to give you what I ended up with. The first calls felt every novelty, and then it became structure as we go. But I was always starting. So let's say we validated that they really have product market fit, and it was not something that was actively sold through great pitching ability.
Before we move on to that, how did you validate for product market fit? Because I think there's a lot of people say a lot of different things for this, so I want to know your take too.
Yeah, the problem is that product market fit is it's great to grasp the concept, but depending on the company that you're running, it may have different metrics. So if I were to put on SaaS, what I would find as product market fit is you have been able. It depends on your ACV, but let's say you have at least around 500K of ARR, 250 to 500K of ARR. Depending on your ACV, if you have one customer at 500K, that doesn't validate product market fit. So that's the reason why you have, I don't know, at least 4 to 20 customers. They stay on your platform, so they haven't churned. And you can use part of them as references. They would refer your business as you go.
That's a solid definition.
Yeah, you can go a bit more. Yeah, you can go a bit more. So nothing touching go-to-market fit, as you've seen. Like, so product market fit is you found, and forgot something very important. That pool of customer is somewhat consistent in terms of their problem and how they look. If you had built 20 different versions of your product in order to build a custom, feature for each and every one of them, because they have completely different needs, it means that you're an agency. You're not yet a product company. So somewhat of a consistency. So I would be asking a few questions like, what's your market, what your product does, how many people have sold the product, tell me about those customers, out of those customers, how many stayed, what's the usage of the platform, what's your ARR, what's your average revenue per, and then you talk, and then you have a sense of whether or not, yes, they have a product that people want. Coming back to the YC definition, they've built something that many people want, or at least potentiality that people want. And some of them, you'd realize that they were still figuring out the problem that we were solving. It's on those conversations you can really see it, and then you help them with another playbook, which is a playbook of do things that don't scale. So it's diametrically opposite. But yeah, and afterwards we would go and, okay, so now let's speak about your market and your go-to-market strategy. Tell me how you go to market. And then you would see that they would do things based on, I woke up Monday and I tried that, and then we did that and we stopped that. They would sometimes, I think the biggest problem I've most times see is people not giving enough thought to how they would go to market, and therefore trying to throw a lot of idea at the wall to see what sticks. But the reality is that you have to believe in some kind of direction and commit at it for at least 6 to 9 months. Otherwise, you're just going to get false positive. Like, it is not true that you can build an outbound motion by just running a few calls from a list that you bought and then say, magically the formula works, or it doesn't. Like, it can, like, it happens, but it's 1 in a million. You actually need to commit. And Aaron Ross, back in the days, who actually was also an advisor in the company, where featured Chronograph as part of his book. He was saying, if you don't give it at least 6 months to get a bit of predictable pipeline, and then another 3 months to see close rate go through, if you're not willing to commit 9 months into that direction, refining and iterating, then just don't do it. Just don't do it and move to something else. So that kind of commitment. And yeah. Do you want me to go through, the various steps, or? Because I'm diverging a little bit, I realized.
No, but please do. I think we can go through this quick enough and then hop into the product.
Yeah, well, the first thing is, tell me who your customer are, and 95% of the time I can tell you what your initial go-to-market motion should be. If you tell me that your customers are $1,000 in ACV, and that they're very, very small business or individuals, well, you're a PLG motion. Try to build outbound on that. You can, but you don't have the LTV, and it's going to be very hard to make it happen in terms of unit economics. But on the other side, if you tell me that you sign 100K deals, It's not because PLG is popular that you need PLG, because people in 100K, they expect services, they expect a different go-to-market motion. And then the go-to-market motion is more likely to be account-based marketing with very senior account executives and BDRs, and you have that marketing flow, but it's very targeted to a certain amount of account that represent your ICP. So tell me your ICV, and then you have a few options on the kind of go-to-market motion that you should start with and scale. Sales-led, sales-enabled, PLG, and so on. And then as you go through that, then you say, well, if you want to put that in place, the first thing you need to lift is pipeline generation. You, as the founder, should be closing. You should be codifying that formula. But before you close, you need to bring leads. And if you want to some kind of find a replicable formula, you need to bring enough so that that cohort is consistent. So you need to focus 100%, 90% on pipeline generation, finding a way to get pipeline predictably from a certain ICP, right? So how do you get those leads into your CRM? How do you nurture them? And how do they become sales opportunities that you move to closing? Funny enough, if you do that, then most of the time, closing becomes more skill sets. And it's probably easier to, at one point, recruit very, very seasoned sales rep who are amazing at taking hot opportunities and transforming them to close one. But finding who wants to buy you, where they buy, and how they're going to be buying so that they can move faster is like, it's the first part of the equation and probably the most important one. So put a metric system in place, MQL, SQLs, and SAL, measure the different channels, and then tell me what are the composition that are important in your market for your ICP. Is it the size of the business? Is it the kind of persona? Is it a segment of customers? Is it what kind of industry, decision maker, vertical? Like, give me them those. Let's structure them, put them in the CRM so that as you load or find those leads, you start to reverse engineer who your ICP is based on how easy it is to get them to discover your brand and convert them into pipeline. And once you found that for one ICP with one channel, then you can move and start lifting closing. And by the way, if you do that, and your market is wide enough, most of the time it's sufficient to get you to 8 to 10 million of ARR when it's scaled, and therefore to get you past Series A up to Series B.
Wow, this is super. This is really, really similar to what I don't know if you're familiar. Camberg Becker, the head of growth at Hockey Stack, a YC-backed company working in B2B attribution. He told me this. He told me, like, the biggest lever that I pulled as a head of growth for Hockey Stack to double revenue in the first 90 days was to reverse engineer close won deals with our best ICP, which was enterprise. Figuring out how are they knowing about the brand, how are they closing, and repeat that at scale. That's it. It's as simple as that. So yeah, that's.
I would add two things to that. The first one is close one is great, please. Yeah. If Marc Roberge was listening to that call, I would say that as well. I think is please also look at retention. There is closed one, but the ability also to keep them. So retention is a big part of it. And for also the people who are going through that motion in place, sometimes it takes a bit of time. So closed one might be a lagging indicator. That's why if you've put a strong model in place, maybe you haven't seen closed one, but you're still seeing pipeline growth rate that is become very, very, very high. And you can, even if you don't see the close rate yet, you can still have a sense of your ICP 3 to 4 months in advance, because you'll see those lead to marketing qualified leads to sales qualified leads going faster through the engine. And then you have to trust that you can close afterwards, but you can gain 4 months on this by having the right data foundation in place to measure it at the left side of the bow tie.
That's the thing. Now we come into the big question, which is current tech, current tools, the way pipeline is stitched these days doesn't provide you with that kind of view yet. But Vasco can help with that.
This podcast is brought to you by FounderVideo. We'll cut your LinkedIn ads costs by at least 50% with natural-looking creatives that prospects actually want to consume. Just have an expert in your C-suite show up to a 90-minute interview once a month and let us take care of the rest. Turn LinkedIn ads from an accepted line item expense into a scalable revenue channel that fits into your go-to-market strategy. Book a free consultation at FounderVideo.io.
So what is the feature set that you have designed for Vasco to provide this unified GTM view that enables you to have lagging metrics and predictable metrics to understand what go-to-market motion you need to go for and how to understand whether it's working or not at the fastest rate possible to engineer that growth, which I get that's kind of like, I was about to ask you about the mission and vision of Vasco, but I think it's pretty clear at this point. So we can hop into the feature set to get more tactical and nitty gritty.
100%. Well, do you want to see it?
If you're happy to show it, for sure. Yeah.
Of course. So the feature set of Vasco is, again, end-to-end revenue operation platform for revenue architect minds. And we do mainly 6 pillars. The one that you would know very, very much from Winning by Design is setting up your go-to-market motion. So basically, what are the dedicated ICP in which you're focusing entire team to go after? Most of the time, it's SMB versus mid-market versus enterprise, or sometimes it's product, it's geography. It depends on the company, but it's really the motions that are very specific to an ICP. Then visualizing the BowTie, and then we'll help you with revenue forecasting and capacity planning. And finally, we do a lot of things to get your data in the right order so that we can extract what you have from your CRM and translate it into how to visualize those insights. So in Vasco, what you would do is you have a no-code mapping of your customer journey. So this would be typically a customer journey that a scaled company would have, where you have marketing sending MQLs to inbound SDRs who are sending sales accepted leads. Think about it as pipeline opportunities to account executives. And you have also 2 other teams, partnership and outbound, who are selling pipeline, and then, implementation, and of course, retention and expansion. And with Vasco, you pick the channels that are relevant for the business, and you can create as many as you want. And you pick the functions that are triggering the handoff. You decide what is the metric. It's fully customizable, and it's really a way to build whatever go-to-market motion makes sense for you. And then I'm just inventing something here. And then Vasco will do 2 things. It will build your forecast and your forecasting plan so that you can actually reverse engineer what each and every function and channel needs to do so that you can hit your macro goal. And it will also connect your actuals from this mega database that your CRM is and reconstruct it so that you can report on that format. So once you've built this, we're going to show you views like this. I'm sure for those who are familiar with revenue architecture and Winning by Design, you'd recognize this little bow tie that you see here. But we're going to show you actuals versus forecast, the volume of leads, the conversion rate between leads and MQLs, the number of MQLs, the conversion rate, and so on, so that you view your entire customer journey in one glance, and you can start driving conclusion of where things are working and where things need a bit better. So if we look at this one, for instance, you're looking at deal size that is a little lower than expected. So maybe you're giving too many discounts. Maybe you're not negotiating hard enough to get the right MCV. Your conversion rate, your win rate is great, and your time in stage is great. But the problem really lies between SQLs to SAL. You see, you were expecting to have and versus benchmark around 84%, and you're only getting 63%. So if you really want to lift your engine, this is where you're going to have the most impact. And then you can double click and you see the spread by channel, which is going to tell you exactly what channels are working and the ones that need refinement. So that's one example, but then you can double click on many, many other things. You can go by channel and see the MR per customer, the distribution. You can look at coverage and attainment by function. You can plan ahead for coverage by just, go ahead and have a view of your entire workforce, their targets, and then you can modify the targets so that the sum of their targets equal the target of the company, and so on and so on. So really, it's the 360 view for each and every go-to-market motion. You can create as many as you want here on what's going on, so that when you are in those weekly business review, monthly business review, quarterly business review, you don't have just to rely on anecdotal feedback to understand what's happening. And you can put the accountability where it belongs, and you can find the ROI by channel and by go-to-market motion, and make the decisions and give accountability at the right place. So this is one of the example here.
This is really good. The benchmarks or forecast numbers, I'm assuming they come from bench sites, or where are those benchmarks coming from, or those forecast numbers based on GTM motion, or from Winning by Design, or from?
So bench sites is amazing. They're not coming specifically from here. At one point, we'd love to integrate them, but funny enough, a lot of venture capital companies are publishing benchmarks online, and there was a lot of benchmarks. So what we've done initially with Vasco is we've aggregated a lot of them, and we've uploaded them in the platform so that we can serve them. But the ones who have bench sites is a great company, and it's probably something where you can refine more those benchmarks. But for now, they're not from bench site. Yeah.
Right. No, that's good though. Like that's a good work still. Like the point though is that someone can also use their own, like this is customizable too, the benchmarks, right?
100%. Yeah. You go on the benchmark tab, and you can pick the one that you want.
That's what people will need, of course. I love to see, because I was curious as well, seeing here the top down and bottom up, being able to see both sides. So I was talking to Chris Walker about this, and the podcast we did, and he said that a lot of the problem with not only signal analytics but all of the analytics and go-to-market analytics, the problem is that they're built bottom up. They're built in a way so that every department gets to choose how to report on the activities. Therefore, they only want to, say that it's working in their own way, tell their story with their data, and nobody will question that, right? Whereas then you look at the top level business metrics like LTV to CAC and CAC payback period and net new ARR against cost of sales and marketing, that kind of stuff. And the numbers don't add up, and they're like, "Oh, the business is not going that great. So how is every department doing so well, right?" So I like that you guys included this top-down revenue view. Tell us more about it.
It's first of all, 100%. I couldn't agree more. It's incredible how forecast has been right now. You have every team that is asked to give what they believe they can do next year. 99% of the time, this is what I've done last year. So if you give me budget X, this is what I can do next year. And there was no concern about potentially saying, well, first of all, there needs to be alignment at the top on what are the goals of the company. Because you're not going to ask the same of customer success and implementation if you decide to grow 100% year over year versus if you grow 40% year over year. It means that you're going to need to recruit way more, and because it needs time to ramp up way early. If you want to reach a goal that is a growth of 100% versus 40%. So every forecast should start with how much do we need to grow by when? And then through that, then you need to understand what are the conversion rates and the unit economics inside the funnel, so that you need to know how many leads it means, how many MQL that means, how many SQLs. And if you have all of that, then you can build targets where the top growth of the company is connected to what needs to happen through the customer journey so that we can hit those goals. But no, like 99% of the time, I'm seeing mostly, as you said, bottom up based on last year forecast. So with Vasco, we try to offer our customers with those tools that help them reverse engineer their targets and what they need to do in terms of hiring so that they can give themselves the chances to hit their target, right? So here you have an example where we're starting with a beginning MR of $90,000. Then you just input what is your growth trajectory, churn assumptions, expansion assumptions, because you need to grow above your churn, and then it's going to give you what's the end goal. So that's very easy. Most of companies can do that. It's typically a conversation between the CFO, the CEO, and the CRO, and they sell some kind of growth to the board. Now, if you get one layer deeper, then Vasco is going to tell you, well, you've told me that those are the channels that are important for your business, and we've built the customer journey in a screen that we've seen earlier. Okay, tell me what is the distribution you're expecting that MR to come from in terms of those channels. And then if we look at organic, for instance, you'll say, well, okay, so based on the distribution, I'm expecting that kind of MR to come from organic and SEO leads. What is my average MR per customer? And what is my average conversion rates between lead to MQL, MQL to SQLs, and so on and so on. And we'll help you with historical data. Vasco helps you find those numbers based on historicals and benchmarks, right? Then, of course, there is also the notion of time in stage, right? It's not when you need the MR that you need to produce the pipeline. If you have 30, 60, 90 days time in stage or sales cycle, well, you need to generate that pipeline early in time. So with Vasco, you input your time in stage, and Vasco is going to tell you channel by channel how many leads, MQLs, SQLs, SAL, customer one you need to do month by month. So your top goal to grow from 90 to 350 is now connected to how many leads by channels you need to hit and by month, so that the customer journey never breaks. And when you have that, then the bottom up is not arbitrary anymore, because you've said, well, outbound is in charge of producing outbound leads. Okay, this is the channel outbound in the top down. In the top down, we've seen that for the numbers to be reached, we need to generate 25 in January, 18 accepted leads in February, and so on and so on. So the targets become mathematical and connected to the top down, and then you only need to go and then put your team and put their targets, and hopefully the sum of the target of the team is going to be equaling the coverage. Otherwise, if your coverage like here is 74%, it means that if everybody on your team does their work and hit their quota, you're going to miss what the company needs to hit by 25%. So yeah, and then you can either decide to change your quota and progressively be more aggressive, or Vasco also helps you planning for workforce, and you build new hires, you give them role, you give them target, you split their allocation. We can go very, very, very far, but we help you target your hiring strategy to make sure that not just at close one, but through the funnel, you hire the right people at the right time, so that you don't miss a coverage.
This is awesome. Can we look at the customer journey mapping? I'm curious to see how it looks.
Yeah, it was this one here.
Oh, yeah, that's what we looked at already. Okay, yeah. Okay.
But nice, again, nice. You could, and I think what's great is that companies are living organism. So if you decide to add a new channel, spin a new functions, add a new go-to-market motion, you know how it breaks every spreadsheets in the world. With Vasco, you just click here, you schedule one in the future, and we'll do all the heavy lifting and reconstruct that one timeline of the company. So it's also, Vasco helps you not with your existing go-to-market organization, but helps you also build a foundation to mature it in the future.
Is there anything like this in market already? Would you compare Vasco to any other tool in the market, or a combination of which ones? And is it a combination of some tools that are already in market, and so which ones? And if not, just how does this compare to the current tech stack that most companies are working with right now? It's coming.
So I don't know if you've seen the same thing that I did, but numbers was always the realm of finance. So finance owned the number, owned budgeting, owned everything. And I think it's great because financial people have a great way to understand numbers and to build a plan. But the thing is, I've studied finance. I come from a financial background. Finance mostly understands the world of what happened at closed one through billing and financial statement output. But how you manufacture growth, how you manufacture sales, that's the work of the CRO. And we are seeing now a much more scientific-minded generation of CRO that are hiring more and more people in revenue operations in order to actually have that conversation with the CFO and have that level of playing fields that was missing in the past. And RevOps, which was a function that never existed, it was a bit of sales ops and a few things like that. It didn't exist 4 years ago. It's now a $3.6 billion industry, and it's forecasted to grow at $18 billion in the next 10 years, 18% year-over-year growth. In a world where go-to-market teams are shrinking, RevOps is growing like crazy. And for me, the way I interpret that is that the high velocity sales model has gone from early adoption to early majority. It's become obvious that it works better. COVID has accelerated that 1,000,000% because now you don't need to shake the hand of anyone so that you can close a 50K plus deal. And now revenue operation has been asked to reconstruct the view from lead to cash, because as you've built that little factory and separated everything into smaller increments, you're losing that view from lead to cash. And what they're using right now is most of the time CRM extract from Salesforce and HubSpot and different sources, and trying to reconstruct that view. And the best of them, they plug a Looker or a Tableau dashboard on it, and the minute there is a change, it's structured, and you need to rewrite the SQLs, and it breaks down, and you need to change strategy, and yada, yada, yada. So it's a new category. And we hope that Vasco is going to be building what HubSpot has done for inbound. Our goal is to build the same, but for revenue operation team, and to really equip them with, spending more time gathering insights and making the right decision for the business, rather than compiling the broken spreadsheets together, so that they can get a static view of the reality in an instant period.
A static and dynamic too, because as you're saying, like, it doesn't break. You can add, tweak, change,
exactly,
everything.
Yeah.
That's
Yeah.
insane. I like it how you put it too. Like what HubSpot has done with inbound, Vasco will do with revenue operations, right? Like, or for that's just simply amazing. So you're telling us, and I can vouch for. I haven't seen anything similar. I don't think there is. There's just not, right? And the current tech stack, it just doesn't support having this type of view and this type of insight, knowledge about and having a true source of truth, which is one of the pillars of
Yes.
having, right? Go ahead.
I mean, you're touching the right world, which is, it's funny, everybody speak about it, building that single source of truth. And right now, every department in companies claim they have that single source of truth. Marketing has the single source of truth, sales has the single source of truth, customer success has the single source of truth. And all of them are working with different data sets that look at their numbers. And often it's the human nature. You want to present the number you look good on. I think revenue operation was brilliant in order to bring that customer journey together, rebuild that view from lead to cash, and get that data set. And funny enough, like, we've been chatting together last time, and in the beginning, it's my second company, so I didn't want to go to market and rah and say, look at my product. I really want to do something different. I wanted to build something that I believed people want, iterate it with a few customers, and then get out of stealth mode and talk about it more well. So this product, it has taken us a little more than 14 months to build, with a team of highly senior engineers. It is not easy to build, and we've been in stealth mode doing that, and we've been iterating with those first customers. And the biggest surprise we got as we went through that is we signed early customers, loved what I show, said this is exactly what I want. We tried to put them live, couldn't. We couldn't because when we were extracting the data from the CRM, it was too messy. Things were not structured. I mean, we all know, you want to measure, I don't know, the ROI per channel, but you have different channels that you have on the contact size than the ones that you have on the opportunity or the deal objects. You're using different objects for different go-to-market motions. Some properties are fields, some are not. As soon as there is something that is not mandatory, you can be sure that you're missing a lot of data. So out of constraints, we actually had to build another module, which is now the first value that people buy from Vasco, which is, we're going to take your CRM and we're going to ingest the data, and we're going to help you build that single source of truth with Vasco Radar. It's going to give you a view of your CRM. It's going to reconstruct what it can reconstruct. It's going to enrich some of the things, deduplicates problems and things like that, and then gives you an exact view so that your RevOps teams can actually build the data model that is recommended by by winning by design, which is the biggest blocker now for people. Everybody believes in the bow tie. It's how do I get to view the bow tie? That is the major challenge.
This is what is the timeline? Somebody buys Vasco, and like in a week they can have their CRM without duplicates, cleaned out, unified. That's
Now,
just
yes.
amazing.
Yeah. Now, yes.
That's amazing.
But we heard it the hard way, because in the beginning I was, okay, this is, I ended up being the person who had to reconfigure CRM and do a lot of things. And we were like, this is not scalable. So we actually built that module out of constraints in order to be able to give that to, and now it's productified within the platform. So
off the record, I guess, can I ask about pricing of this? Like, is this actually, like, is this meant, because I was about to ask you as well, like, who should be using Vasco? It's clear to me, CROs, RevOps people, right?
yeah.
Those are, although, this is another question too, but like, you mentioned you come from finance background. There's a huge disconnect between go-to-market and finance usually. Recently I talked to James McKay, who runs a RevOps consultancy firm, and he said FP&A is the easiest plug between RevOps and finance. They should be looking at the same stuff. But yeah, so many questions there, right? Like who should be using it? Who is it for? What is the best ICP, I guess, for Vasco? And if you can or want, talk about on pricing. If not, we can remove my question on that. That's fine.
No, of course, happy to speak about pricing and everything. So right now what we've realized is we started with SaaS because we wanted to start with a niche and really software. We don't want to be too generic and not deep enough. I think you need to be deep, like devil is in the detail for those kinds of products. So we went super deep for SaaS. Though I'd love to hear what you think about, but I think the revenue architecture framework applies for every B2B businesses, not just SaaS companies.
Yeah, I think that it applies to every recurring revenue business, whether it is service, software, even info products these days, like whatever it may be. So long as it's B2B, I think it makes sense. Like it's
Yeah, 100%. And so the customer we have right now, so we're making a conscious choice of not taking customers who are not having product market fit or not on the verge of having product market fit, because for them, it's not a gift. They should be more thinking about getting to product market fit rather than thinking about how they scale their engine. So I would say, like, typically, if I were to give a ballpark number, even though we know that those situations can be different, we are fit for B2B businesses between $1 to $100 million of ARR so far, with a sweet spot 5 to 50, but between 50 and 100, it's like the difference is not that big. It's just more go-to-market motion and a bit more people. Before 5 million of AR, you realize that it's more for people who try to implement go-to-market fit. Funny enough, we've gotten success more by going indirect with them. So we have a lot of revenue operation agencies or advisors or coach and so on that are using Vasco as a forcing function for their companies. But the ones between 1 to 5 generally need a bit of help and services. And often it comes from our partners.
Nice. Does that mean that Vasco won't be for enterprise?
Vasco is for, well, yeah, you could argue that when you're 100 million of AR, you are for enterprise. But Lightspeed is using, part of the business of Lightspeed is using Vasco, and we're very grateful for their business. So it's a great use case, but it's more of a choice inside the company where we're like, okay, we're going to define that so that we make sure that we build for this, but it's a fit for a bigger company as well. More than happy to evaluate.
Okay, sounds good. And pricing wise? So
pricing wise, the platform starts at $1,500 per month, and if you have a lot of complexity, integration, and so on, the enterprise plan goes to $4,500 per month. But we try to have an initial price that is not too high, and that can tailor to the budget of startups.
No, that makes sense totally. I mean, one could argue it's like the work of more than 4 people easy. Like
Yes.
try to do that with labor, right? Like the
Yeah.
whole writer thing, like that's already
Well,
time to
one
value is
wrong
there.
one wrong hire, too soon, too late, or so on, or that doesn't work, costs approximately 30K to the business. So you already have a 2x return on investment if you just don't miss one hire at the right time. So that's the way we thought about it. And we also take a lot of time ourselves. We're very, very close to our customers. We spend a lot of time with them to make sure that we just don't give them the platform, but we also provide them with the insights, the tools, and so on, because we really, really want to get close to those customers and their needs. So for us, we wanted also to justify that from a unit economics perspective, because when you buy Vasco, you don't just get the platform and set yourself up. We are there along the way, step by steps, not just to implement the platform, but also to help you with your go-to-market strategy and implementation.
Love that. How are you planning to get go-to-market fit with Vasco right now? I'm curious.
So I do believe we're. It feels we're there. At least what I'll tell you is when I'm looking at the pipeline growth right now, it's impressive. So it means the product is really resonating. What I love is that I'm actually receiving a lot of opportunities from some VC funds, some agencies, some people from various backgrounds found a way to find us because they really want that. And for me, it's really exciting because it means that we're touching, I think, a very sensitive part. Um, I mean, a lot of startup and scale up, they don't die because they didn't find product market fit. They die because they lost or didn't find go to market fit. And they treat sales as an art and not a science. And, if Vasco were to succeed and become that success, my personal why is to give them a better chance to compete against the giants, and we can increase the probability of success of those startups and scale up by helping them find faster and better go-to-market fit and making sure that the idea that they had reached the world. So right now it's resonating. We're seeing a lot of growth in the top of the funnel. We have big ambitions. We're VC backed as well. We raised a pre-seed round of financing that we didn't announce, but it was early to start the development and hire the right team. And our goal is to continue through that road.
You plan to raise another round pretty soon then, I'm assuming, or not?
So when I looked at the market when we raised the first round back in 2022, 2023, I didn't really like what I saw in the short-term provision. So we raised enough cash to get sufficient runway. So we're in a very fortunate position. My co-founder and I, Sebastian, was my CTO, as one of the amazing brand behind the platform as well. We said that we wanted to raise sufficiently so that we can hire very senior talents in the beginning of the company, because this is a complex product to build. So we want to make sure we had that talent and give ourselves enough runway so we don't need to raise every 18 months. So fortunately, we still have a lot of runway. But if traction continues to be as it is, we may raise sooner than later just to keep the momentum going.
Totally. Yeah, makes sense. Let's talk about the disconnect between go-to-market and finance. You coming from a finance background, we've mentioned briefly that FP&A could be the plug and whatnot, but you have a lot of experience too. Like you've been in the VC world, you've raised, now you're raising again too. You've been in M&A, you've seen the numbers. So, how have you experienced that disconnect between finance and RevOps or go-to-market? And how do you see it fixed? Because I'm assuming that was not such a problem in Chronogolf and Lightspeed, and certainly not at Vasco, of course.
Yeah, well, in Chronogolf it was easier because my co-founder and I, we had 4 co-founders, but the ones that was co-CEO with me, we were actually 2 co-CEOs. We both came from financial background, and we were running different part of the organization, so we did understand finance, and we had to understand operations, so we could speak both language and flex both language. I think this is how actually the idea for Vasco was connected, is to connect the world of finance to go to market to data. But when I see those worlds, I think the problem is that finance has a lot on their plate, um, because they are the ones that ultimately, if the company runs out of cash, they're the ones responsible. If the company runs out of cash or if it gets bankrupt, the VC are going to turn to the CFO and says, what happened? If you missed Runway by 6 months, the people are going to look at the CFO and say, what happened? So by very nature, CFO will be more conservative. And the problem is that most of the time when they receive numbers from other parts of the organization, those numbers are not formatted in a way where they can really trust it. So what happens is that actually they say, well, you know what, we are going to build the numbers. But their world is more the world of closed won, to build, to retain, to expand it, to P&L and cash flow statements. But everything that happens before is a bit complex. You know SaaS as much as I do. You have to pay the customer acquisition cost upfront, and you receive the money in the future, which means that the more your SaaS grow, the more it costs cash. And that math, you can combine it as a CFO, but then you need the CRO to say, well, I believe that if I get this more, this is the conversion rate I can get, this is the volume of leads that we can get, this is what can happen, and you can really reverse engineer that growth formula from here to here. And if you show numbers, because the CFO wants to see numbers, P&A wants to see numbers, if you can see and show the numbers and back those numbers with math, I think this is how you rebuild that connection. Because the CRO ultimately knows how to motivate the team and to build the growth and to manufacture the growth. It just needs to speak the numbers language so that they can have a common language, let's put it this way, on which they talk. Hopefully Vasco will help a bit with this, but you can still do a bit more if you have a good revenue operation teams that starts, revenue operation is kind of bridging that gap too, right now, building those spreadsheets together and compiling that view between the two worlds.
Totally. Yeah. If there's someone bridging that gap, it's definitely RevOps. That's for sure. Because they're the most connected to the numbers that move the needle one way or another.
Yeah.
How do you envision the future of GTM with Vasco? Like, what do you think it will do for companies and just to the day to day of CROs and finance people too? Like, what are some specific differences you've dreamed about already? Like, I want, things that I've seen on and on and on and on once and once again with those 50 founders that you talked to before starting Vasco. You were like, okay, I'm repeating myself here. Like, I need to productize this, right? To shift into what paradigm? Like, how does the world look like with Vasco being adopted by many RevOps teams? That's kind of my question.
Yeah, I think the world has shifted from growth at all costs to sustainable growth, and the notion of efficiency has become very important. I think that's very healthy. And if you look in various parts of the world, it's funny, but SaaS is very, I would still call it resilient. Like, people believe that SaaS is still the future. I don't believe AI is going to replace SaaS. I think AI is going to have the same importance than cloud had versus on-premise software. AI is going to be enabling SaaS, and the SaaS companies that integrate AI feature will be the ones dominating in the future. But SaaS has a lot of great days ahead. But now it's an industry that is just not just novel. It's an industry that has matured and people understand its mechanism. And I think it's about making sure that you grow with more efficiency in mind. And that efficiency needs to be measured and needs to be put in place. So the thing where Vasco, I hope, can have a dent is that everybody agrees on that new version of the world. Everybody agrees that this is the direction. But when it comes the time to actually take your data from your CRM, put it into a data model that works, realizing how your data is actually not fit, and trying to build that normalized data set and going through that loop, a lot abandon because it's too much work and it's overwhelming. What I hope is that Vasco is going to help that transition be much smoother for those companies and increase their chances of actually hitting their numbers and the right numbers so that it can survive to Series C, Series D, Series E, and understand what's the next natural best step. For those companies who went through transformation, most of the time it was through very hurtful layoff plans. Those could have been avoided for some of them, if you knew really where you were winning, if you had really great unit economics and performance and so on. you would be backed. The reason why this was more complicated is because, like, I don't know, you've been pouring millions of dollars in a channel that has an LTV over CAC of 0.5x, and you're discovering it by spending 2 months recompiling the data, or you've hit $8 to $10 million of AR, and the problem is you think you have go-to-market fit, but you do have go-to-market fit just on one motion, that channel for that type of ICP. And yes, your TAM is gigantic, but you're only targeting the active buyer for a specific geography on a specific channel. So at one point, yes, it's starting to plateau. You didn't anticipate that actually you were at the threshold where you need to open a new go-to-market motion, not to expand your TAM, but to address your TAM that is looking at the kind of problem space solution that you're offering and looking at solution from different channels. And hopefully Vasco will help avoid some of those mistakes, which sometimes costs amazing products to die. I don't know if you agree, but I think in B2B, I think go-to-market fit is as important as product market fit.
If not
B2C,
more.
If not more. Yeah.
If not more. Because we talked about this in our previous call, right? Like how it's getting easier. It will never be easy to get product market fit, but if there's one point in which it's been easier, it's now. I think 15 years before, you couldn't build the type of products as fast as they're getting built these days, right? And finding needs, and this trend of, we can talk about this as well. I would like to get your take on this episode as well, like this trend that we're going through in SaaS, that we're seeing more and more verticalized softwares that are
Absolutely
specific for a specific need, and not just a generalist HubSpot hub for everyone and everything, right? And I think that's an indicator as to how many opportunities are being opened for founders to find product market fit. Like before, finding product market fit was like, I need to find a needle in the haystack, right? It still is like that, of course, but the haystack is now way smaller, I think, right? And there's more needles to find. If you could put it like that. I don't know. How do you think about it, though?
No, I fully agree with you. And the world has gone. Adoption of software technology has made that now you have a bigger total addressable market, but people are expecting much more customization. In the world of verticalized SaaS, like I really want a SaaS that fits what my problem solution space is as a prospect and a customer. I think YC, for instance, I remember seeing a tweet. YC was actually making an active call to find verticalized ERP solutions. So I found that very, very, very interesting.
I saw that. Yeah, they have, how's it called? Notes for startups, no, reference for startups. This document that they publish every year with things that they want to invest in, right? And that was one of it. ERP, verticalized ERPs, like customizable things that actually, for a specific niche, whatever.
And my vertical, my problem space, I don't want to use that big ERP, like, I don't know, Oracle for everything, I really want to get for my use case. Yeah, it's going to be a challenge because as a company, it means that the way you build software, if you want to target a big TAM at one point, it will need to be very modularized as well, because they don't want all the extra stuff. They just want the stuff that's tailored to their use case.
And that's what we're seeing too. I mean, I've seen it with some clients too, like modular tools with a bunch of different options and pricing that also moves accordingly to that. I think we're going to see way more usage-based pricing in the upcoming years, right? And that I think we were talking about this the other day on another episode too. The difference between contracted and non-contracted revenue, and thus, like if you have a usage-based model, how investors can tell if that revenue is actually recurring or not, right? Like, where is the line to which you say, okay, well, this customer has been paying for the same amount of credits, or at least this amount of credits, the average amount of credits per month that this guy has, this customer has been, purchasing for the past 12 months is this, so we can assume that is the recurring revenue. Now, I don't know how is that playing out in valuations either, but for example, Clay has just gotten to a $500 million valuation with their Series B, if I'm not mistaken. I think it's Series B that they raised recently, and they have usage-based pricing. So I don't know, what's your take on that? Yeah.
Well, So you're talking about usage-based pricing, which is a very specific example on which I agree with you. And then there are other type of reoccurring revenue that is not really recurring revenue, and then people are trying to paint to get a higher multiple on their runs. It's still unknown, but I'll give you my intuition of my 2 cents on this. Is if you look back in history, you used to buy on-premise software, all the risk was for the customer. You would have dents from the salesperson, and you would buy that package that you would use for the next 3 years. And then you wanted to get the new version of the software, then you had someone that just would sell you again. But all the risk was shifted to the buyer. Then SaaS came in, and with SaaS came also a new model where you need to make sure that as a seller, you show impact because otherwise your customer churn. So you have to show impact, but not just once. You need to show the first impact, and then you need to show recurring impact. And recurring impact is what helps you have your customer continue to pay for your platform, but buy more of your services. I think usage-based is actually embracing the fact that as a company, I'm going to take upfront more of the risk so that as a buyer, you're going to get the value that you need. So there are subtleties, it doesn't apply for everything and yada, 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 but let's just take the first principle out of it is right now, if you are tailoring the price and the person just pays exactly what the company needs and pays therefore not a dime more than if they had to pay for various packages, half of them they don't use, well, they're going to use the thing that they pay and they pay as you go. It's a much more efficient pricing methodology because it's shifted towards the buyer. And I think history has shown repeatedly that if the buyer will always choose the thing that's more convenient for her. So I think usage-based pricing has a lot of good days ahead because it's just shifting the risk and the impact onus towards the software company. And the customer is always right. Now, speaking about it, I think usage, it should be treated as recurring revenue, right? Because it's just you're selling a platform that is recurring, and unless you have huge variation because you have seasonality and people turn down and so on your platform, as long as you have some kind of correct standard deviation between an account, it's just a new pricing methodology that should be considered somehow recurring revenue in terms of multiple, because it's just different pricing that gives more power to the user. And yes, maybe it means a bit more variability, but unless you have a standard deviation that is really, really hard from 1 month to the next, it's still SaaS, it's still recurring, it's still this. What do you think?
I agree, but that's a good point. You need to add the deviation. You need to, be conservative with that and account for some margin of error there. But I agree with you. It's just another pricing model. And I think the good thing about it too is that, holding the risk as the provider and removing the risk from the buyer also forces companies and founders to build better products. And, in the same way that we were saying that it's easier to get a product market fit these days, or, there's more needles, the haystack is smaller, whatever, because of the verticalized trend. In the same way, too, on the big picture, the haystack is bigger than ever in terms of amount of tools that go out every day. And this shift in the business model from all the risk is on the buyer and now all the risk is on the provider, also plus all the competition that comes with that, is that you need to build a solid product that people actually love and use. There's no other way around it. You cannot have a sort of mediocre thing with it's really useful, but the UI is not the best and we're still missing this integration, and people still buy it because there's no other option. It's not happening anymore, right?
Exactly. And you said it, that people love and use, and recurring impact.
Totally. Now, to wrap up, I wanted to ask you, this more of a personal, this is an opinion that I don't think there's right or wrong in this debate, but it's a heated debate and everyone, talks about it here and there. The bootstrap versus VC backed route as a founder, most importantly from that POV. You've done it once, you're doing it for a second time now, and you've been in the industry. There's a lot to be said about the pressure that it puts on you to have VC funding and the growth rates that you need to reach and all of that, and that a lot of people are not claiming, well, it's way better if you go bootstrap because you don't have the pressure and you can build a cash cow machine and whatnot. But the way you talk about it, to me, it shows that you've made the learnings to have a better grip over go-to-market fit that maybe a lot of people that get VC funding might not have, and therefore are not that happy with their situation, right?
Yes.
So that's what I think it is. I don't know. What's your take on it, and how do you think about VC versus bootstrap and whatnot as a founder?
Yeah, I'll start with the end part of the question. I think a lot of the frustration that comes from some of the founder is that during some kind of era, they sometimes found go-to-market fit potentially on one channel with a bit of luck. But at one point it stopped to work. And then that's when VC asks question in boards. And then you have two companies, the ones that are able to give clear answer to that, and the ones that you realize actually build a great product, find some kind of go-to-market fit, but actually never really understood how it works. And when it stops working, then that's when hard conversation starts to pile up. Some companies are just widely different. They build a product that is just so different that they skip that stage, but it's 95% of the company out there. And for me, VCs are more, they're, first of all, in those board meetings, they always respect you if you come up with the answer. The problem is if you come 3 boards on a row and you still don't know what's your quota hit rate, your conversion rates, your win rate for certain verticals and so on, because then they feel you don't have the hand of the wheel. And that's why they're putting pressure. If you have the end of the wheel and it doesn't work and you're still refining and you have a plan, then they will keep the trust and you'll get that bound back together. Remember that most of the VCs come from financial background. You need to talk data to them. Coming back to the CFO versus a CRO question. And then, some companies don't get to choose. Some companies, the market is not just not wide enough to get VC money. And that's totally fine. And then bootstrap is the right way, a few business angels and so on. But for the one that can choose, then VC is a way to go faster and to have a bigger impact because you're raising more cash and you're accelerating growth. And for me, it depends as a founder, what is your personal ambition? You say it's a lot of pressure, but my first company, I bootstrapped it for 2 years. And I can tell you that when I was looking at my bank account and my credit card statement at the end of each and every year, I can tell you it was a different stress. It was not the VC, it was a different stress. So Bootstrap comes with a lot of stress as well, especially in SaaS, where, again, you growing costs money because you pay the customer acquisition cost up front and you get the money in the future. So I would argue that VC also gives you a nice lifestyle in terms of it prevents you from those very hard days of bootstrapping, but it increases the risk of the company because your margin of error becomes very much more small. And it becomes, you as a founder, what do you want? Do you want to have a huge impact and go super fast and build an enormous company, or do you want to build a protected company that has a moat in a certain region or market and whatnot? And then, I think it's a matter of personal preference. Some companies also don't have that choice. Like, go build an AI model, bootstrapped today, or you cannot be the AI of this town or this region or whatnot. Tech has very little frontier because it's selling everywhere. If you have a retail store, brick and mortar in one avenue, one region, your defensible advantage is all the people who walk there. You don't buy tech because you go and walk on the street and see that super tech software brick and mortar store and you want to buy a product from here. So there is also a risk with taking too long and not accelerating fast enough, is that you're going to get copied by people who are much more capitalized than you and who actually are going to take your bootstrap advantage and actually destroy your market share. So it's a very complex question, but I would never, it's easy to say that VC is tough and bad and so on, but it comes with a lot of necessary and positive too. Anyway.
Yeah, I love that answer. I mean, it's case by case, but I like the I mean, of course, like you can go way faster and everything. I just think it's case by case. There's companies that are going to do better if they bootstrap for a certain period. There's
Mhm.
companies that are gonna need the funding right away, and that's fine too.
Yeah,
And I like the way you put it because that's a pretty good counter argument that you don't hear as much. Like, you say VC is pressure. I was way more pressured bootstrap when I had to put my own credit card. Right, like it's nowhere near close. Like if you're actually putting your money where your mouth is,
yeah,
bootstrap. It's if you want to build the same kind of business. That's the thing. Because if we're talking about different businesses, then it depends. But if we're talking about building the same company, doing VC or doing bootstrap, and you're in SaaS, few examples. I mean, I love Zapier's story, for example. They only raised like 25 million from, well, only it's money, but they raised once from Sequoia. I don't think they raised ever again.
yeah.
And they're, I don't know, 200 million ARR right now, probably more. So yeah,
Mailchimp,
and
I think, is a story like that.
yeah, Mailchimp is
But
bootstrapped too. You have now RB2B. I don't know if you know from Adam
but
Robinson's.
yeah, but coming back, and this I don't know. I'm just going to try to infer something. But when you look at Zapier and Mailchimp, they are small ACV, high volume of customers selling completely PLG. If you're enterprise SaaS, so sometimes you don't have the choice actually that you think you have.
I think so too. I mean, look at Hockey Stack. Hockey Stack was not selling enterprise at the beginning. As soon as they raised, they got into enterprise, and that's what got them to the level of revenue they are right now. That's it. Like that's it. There you go.
100%.
And I agree with you.
Yeah,
PLG, it's just a different breed. If you're able to build a proper community online, you have organic reach. Like
yeah,
it really is easier. But when you have high touch sales, long sales cycles,
yeah,
and that CAC that you need to pay up front keeps growing and growing, then it's probably
100%.
yeah.
It's because when
Also,
you're micro SMBs, or in the beginning, and some of them grew outside of that, it's almost a B2C playbook in some way. Uh, and B2C playbook
I
comes
can
with virality, word of mouth, and this is how you grow. But you can have an amazing business that is not a PLG motion. By the way, PLG motion will likely not work for a certain size of ACV because people will expect the service, the sales process, they will expect to go through different hurdles and so on and so on. And it's, yeah, again, it
yeah,
depends.
I compare PLG products or no touch SaaS to the closest thing to info products or courses, that kind of stuff.
Yeah,
It's
yeah.
almost the same thing. You can sell it with the same go to market motion in a way, and that's
Yeah.
an interesting analysis to do as well. But either way, I don't want to keep dragging it. I think this has been a really great episode. If anyone wants to know more about Vasco and wants to learn about the tool, of course, I would encourage you to go to their website and book a demo with them because this is really one of a kind. I don't think there's any other platform in the market right now that's doing something even close to this. So yeah, great stuff. It's a pleasure and an honor for me to have you on the podcast. I think it's the first podcast you're doing, if I'm not mistaken,
It's the
right?
first one I'm doing, yes,
So yeah,
for
it's a
Vasco.
pleasure. It's a pleasure to be the first for Vasco, and yeah, go check it out because it's really good stuff. I think. Anything you want to say about the future of GTM? Just a message, whatever you want to you want to drop to wrap up.
No, no, that's, I think we said it all. I just say this is more the entrepreneur in me. I think like if I were again to live it to the people out there who are fighting in the trenches to trying to grow into that new world, is that again, go to market fit is as important as product market fit in B2B software, and you need to invest in it and really treat it scientifically. And the company who do that are a very, very bright future in front of them. And I think SaaS has a lot of glorious days in front. It's just a kind of a new reality. But thank you so much for having me on that podcast. As you know, we've been in stealth mode, really, really spending time building the platform, and we're going out of stealth mode now in order to have that product in the hands of more people in the world. So thank you so much for hosting me, and I hope you appreciated the session as much as I did.
For sure, I do. Yeah, it's been a pleasure. We'll stay in touch and hopefully have you back whenever that Series A comes or whenever the time is right.
With pleasure.
Yeah, pleasure.
Thank you for listening to the Founder Video Podcast with Will Martin, and we'll see you on the next episode.